You check your credit score, and your stomach drops. It's lower than you thought. Maybe it's in the 500s. Maybe it's sitting right at 600. And somewhere in the back of your mind, a voice tells you homeownership just isn't for you right now. Here's the truth almost nobody explains clearly. A lower credit score doesn't close the door on a mortgage. It just changes which door you walk through. Most people think mortgage approval works like one locked gate. Score high enough, you're in. Score too low, you're out. That's not how it actually works. There are several mortgage systems running in parallel, each with its own rules. Once you understand that, the process stops feeling like a mystery. Let's start with the number that scares people the most, 500. That's the lowest credit score where a mortgage is even possible, through an FHA loan. FHA loans are backed by the Federal Housing Administration, which insures the lender against losses if you default. That insurance is exactly why lenders are willing to approve someone a conventional bank would reject. With a score between 500 and 579, you can qualify for an FHA loan, but you'll need a 10% down payment. Once your score crosses 580, that requirement drops to just 3.5%. On a $300,000 home, that's the difference between putting down $30,000 and putting down about $10,500. So the first move, if your score is low, is finding out exactly which side of that 580 line you're on. A jump of a few points can save you tens of thousands of dollars up front. Here's where it gets more interesting. FHA sets the floor, but individual lenders can stack their own, stricter rules on top of it. This is called a lender overlay. One bank might reject anyone below 620, even though FHA itself allows 580. Another lender, working from the exact same guidelines, might approve you without blinking. This means the lender you choose matters just as much as your score. A rejection from one bank tells you almost nothing about the next one. Shopping multiple lenders isn't just about comparing interest rates, it's about finding the one whose rules actually match your situation. What about conventional loans, the ones not backed by the government? For years, the unofficial floor was 620, but that shifted. Fannie Mae and Freddie Mac, the two entities that guarantee most conventional mortgages, removed the strict 620 minimum from their official guidelines in late 2025. Lenders can still set their own minimums, and many still hover around 620. But the rule book has more flexibility than it used to. Mortgage guidelines aren't fixed forever. What was true about needing a 620 a few years ago isn't automatically true today. So if a lower score doesn't disqualify you, what actually determines approval? 3 things matter more than your score alone: your debt-to-income ratio, your down payment, and your payment history over the last 12 months. Your debt-to-income ratio compares your monthly debt payments to your income. Your score tells a lender how you've handled debt in the past. Your DTI tells them how much room you have right now. A borrower with a 600 score and a low DTI can look safer on paper than a borrower with a 680 score drowning in car payments. Your down payment acts like a counterweight to your score. The more you put down, the less risk the lender takes on, and the more willing they become to overlook a lower number. And your recent payment history carries outsized weight. A late payment from 4 years ago matters far less than a clean 12 months right up to your application date. Those months aren't just waiting time, they're proof you're actively handing the lender. One more detail almost nobody explains. If you're applying with a co-borrower, lenders don't automatically use whoever has the worst score. The old standard was to use the lower of the 2 middle scores. Some conventional lenders now average the 2 instead. That single policy shift can be the difference between qualifying and not, depending on how your scores compare. So what should you actually do? Find out exactly where your number lands, because the path changes with it. Below 500, a mortgage isn't available yet, and credit repair becomes the priority. Between 500 and 579, FHA is likely your only route, with that 10% down payment. At 580 and above, the down payment drops sharply and your options widen. Somewhere between 620 and 680, you're in a real crossroads zone where both FHA and conventional might work, and the better choice depends on your down payment and long-term plans. Talk to more than one lender. Because of overlays, a single rejection is a data point, not a verdict. Look at your debt-to-income ratio with the same seriousness you're giving your credit score. Paying down a credit card before applying can move the needle more than waiting months for your score to inch upward. And understand that a lower score usually means a higher rate and mandatory mortgage insurance, not a rejection. On FHA loans, that insurance often lasts for the life of the loan unless you refinance later. That's a real cost, worth planning for. But it's a cost of the path, not a locked gate at the entrance. Here's what all of this really means. The mortgage system isn't one gate with one number posted above it. It's a branching set of paths, and your credit score decides which paths are open right now, not whether you're allowed to walk at all. You checked your credit score, and your stomach dropped. But the number on that screen was never the whole story. It was just the first fork in a road that has more doors than you were told.